Good morning and welcome to this Wednesday, November 25th, 2020 edition of Trading Places live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. First off, I just want to wish everyone a happy Thanksgiving. If you are planning to travel this weekend, stay safe. And of course, social distance as much as you can. I know everybody wants to get together with family, but we do still have to remain vigilant here for the next few months. Let's get these vaccines to kick in and hopefully return to some form of normalcy in 2021. But in the meantime, let's try to everyone stay safe as much as possible. Futures a little mixed this morning. The Dow's down, S&P's down, NASDAQ up. Today's going to be interesting. See what the growth stocks do relative to value. I'll talk about that in a bit, but maybe it's a little encouraging to see the NASDAQ up this morning while the others are down. We'll see whether or not the growth picks up because we did go down and close just below what I consider to be a fairly important short-term support area. I still love growth stocks going forward. I'm talking about short-term if we have a breakdown, because growth stocks have just been going crazy relative to value throughout the year. And you'll see when I pull up the chart, it wouldn't hurt to have some consolidation. And I think the first sign of confirmation of that would be this breakdown that I'm talking about. And again, we'll look at that in just a bit. One thing I do want to do, though, before we get started, I always like to do this, is start off with what we offer at Earnings Beats. If you're new, we do have a free newsletter. It comes out every Monday, Wednesday, and Friday morning, usually before the market opens. And just an opportunity, take a look at one area of the market, maybe an individual stock, could be to point out relative strength, earnings related, something along those lines. This morning's was a little different. I actually looked at one stock from a more bearish perspective, pointing out a potential Head and Shoulders top. And normally I don't pay any attention to bearish patterns when I'm very bullish the market like I am now. But I think that there are some of these growth stocks, especially, some of the smaller ones that just took off throughout this year, that it might not be a horrible thing if they were to pull back for a period of time. You certainly don't want to be in those when they do pull back. But there was one in particular I mentioned earlier today. It's those types of things that I just try to draw attention to in the newsletter. It is completely free, no credit card required. You can unsubscribe at any time. But if you'd like to be a part of that, simply type in your name, email address, hit that subscribe button. If you want to try our service, and I would highly recommend it, if you're already a Stock Charts member, it really fits like a glove with the tools that are offered, tools and features offered over at Stock Charts. And even if you're not a Stock Charts member, there's still plenty of information that comes out throughout our service. I think that would be very valuable as a trader or an investor. And we do offer essentially a no-cost trial. It's $7 to join, but then we refund you the $7 within 5 to 10 business days. It's simply to get you in our system, which requires a credit card. So that one's a little bit different. It does require a credit card, but it is free for 30 days. But you can check that out. Here's our portfolio performance. Last Thursday after the close, we restructured our portfolios with 10 new equal weighted stocks in each of the 4 portfolios. Currently, they're all leading the S&P 500 since Thursday's close, but we did give back some of the gains yesterday as we saw a little bit more of a focus toward the value stocks versus growth. Our portfolios this quarter are a little bit more of a mixture of growth and value, where we've been with growth all year long, started looking a little bit more at value, especially in the industrials. And I think that's one of the things that's helped our portfolio so far this quarter. All right, let's move on. Let's take a look at what happened on Tuesday. The Dow Jones Industrial Average actually hit 30,000 and closed above 30,000 for the first time in history. Beautiful move up. Been expecting this. I think that this is the start of a continuing move to the upside. I've said before, once the Dow got through 30,000, I wouldn't be surprised if quickly on its heels we see 31,000, maybe even 32,000. We'll see whether or not that happens, but we are in the most bullish period of the year historically, which goes all the way through January 18th. I wish it was June 18th. goes all the way through January 18th. So historically, the market tends to do well this time of the year. Also, in the very near term, right around Thanksgiving through the first week of December, we tend to go higher. It's a tendency, not a guarantee, but historically, we've got those tailwinds, hopefully helping to carry the market a bit higher. So the Dow, strong day, up 454 points. S&P 500 up 58, 1.62%. NASDAQ back above 12,000, up 156 points or 1.31%. Mid caps and small caps especially, look at that move to the upside. It is absolutely just exploding. Part of it, I think, well, a lot of it has to do with the virus and the vaccine news that's come out the last couple of weeks. Small caps were really hit hard throughout 2020, especially back at the beginning of the pandemic, March, April, maybe into May. And they've started to rally back. They're outperforming the S&P 500. You can see here in November with the vaccine news, we've had a huge move to the upside in small caps. So that's good news. We want wide participation. We want all of the different areas of the market to perform well. And we're starting to see that. Take a look at energy, which had been the laggard, the absolute worst performer. Yesterday up 5%, continuing its stellar move to the upside. Financials, which I might argue were, I don't know, maybe second, third worst group, certainly in the bottom half of the sectors. They've come to life here in November with the vaccine news, and they broke out again yesterday, rising another 3.5%. So financials looking better. Real estate, maybe not as robust to the upside, but we are seeing some more movement to the upside, holding on to the rising 20-day so far. Pretty good news there. Now, we did pull back yesterday. Real estate was the worst performer. I want to point that out. I think it was the only sector that was in negative territory yesterday. But even with that, we still see, in my opinion, what looks like the start of potential uptrend. So watch, I say 36.50. I'll give it a little room to the downside, not a lot, maybe 1% or so. But if we can hold on to about 36.50, I suspect the next move in real estate will be higher. Marine transportation has certainly been benefiting here in November. This was a really poor performing group throughout most of the summer, but we have come to life here in November with the vaccine news. I don't know that this is a group that I think is going to go skyrocketing for a long period of time, but I think it's a relief rally. I think same thing going on with energy. Just it was beaten down so long that we're getting a little bit more emphasis on the buy side in that area right now. Same goes with marine transportation. Gold miners, miners in general, not performing well. I've said before, I'll say it again, I'm not a fan. I think the long-term relative weakness that started all the way back in 2011, I think that's still in play. So we had some really nice relative strength in this area, probably for 6 months or so. But I believe it's all rolled over. You can see on an absolute basis now we're trading down close to the June lows. We're not far from potentially taking out June lows. So we want to be careful with gold miners, mining. And there's a couple of reasons for that. Number one, with the vaccine news, a lot of the fear is going out of the market. Fear tends to drive gold and gold-related stocks higher on a relative basis. When the fear is rising, gold tends to perform well. When fear is subsiding, gold does not tend to perform well. That's one thing. The other thing I think we got to be careful about is the US dollar. I'm still seeing signals to me that suggest we could see a rising dollar again in 2021. And if that's the case, that's another reason to get out of gold and gold-related stocks. So I think that could be playing a role here. Although in the near term, I think the more pressing issue for gold and gold-related stocks is the volatility index, which is dropping. All right, update on the 10-year Treasury yield. It is currently at 0.875. We are back above that 20-day moving average. That's what I was looking for. We pulled back after we had that huge surge with the vaccine news back on November 9th, pulled all the way back, filled that gap. And now I think we're starting to trend higher again. That's good for the market. Normally, when the 10-year Treasury yield is falling, well, not normally, always when the 10-year Treasury yield is falling, it means money is rotating into Treasuries. And that normally can put pressure on equities, but that has not been the case. I mean, if we look at the S&P 500, over these past couple of weeks, the S&P is moving up and setting new highs. So it's doing so without the money rotating from bonds to stocks. Imagine what happens when we do get that rotation and the 10-year treasury yield starts to move back up again. That tends to create cash available to move over into equity. So I'm still really bullish. When I see the 10-year treasury yield going down and stocks not going down, it's telling me that there's enough new money coming into the market to hold up equities. Because otherwise, you would be expecting rotation away from equities into bonds, but that's not what's been going on. I think that's bullish. All right, let's move on into talking technically. I do want to point out this IWF, IWD chart. This is something that I've been pointing out. We talk about a lot at Earnings Beats with our members. And this is that longer term chart. Well, this is a 1-year chart. I could go back even further. Let's go back a little bit longer. Let's go back a couple of years here. So, I mean, we were already trending higher, but when the pandemic hit, and you can see even before the pandemic hit, we saw, I mean, growth stocks were starting to be accumulated. And the reason for that is simple. Back in January and February, we were actually seeing GDP forecasts raised. There were some forecasts that were calling for 5% GDP back then, which would have been the best GDP of the century in the midst of record low interest rates. When you get a strengthening economy and record low interest rates, valuations are going to go higher because you've got growth in earnings coupled with very, very low interest rates at which you discount those future earnings by. So it made perfect sense that it was going up. Then the pandemic hit and the stock market fell apart, but look at the money rotating into growth. I mean, I wrote, go back and look at my articles. I wrote back in March and April, we were still in a secular bull market. Probably a lot of, I got some emails, trust me. A lot of people thought I was nuts. They called me perma bull. They called me all kinds of different things. But that's okay. You can call me anything except late for dinner. I'm fine with just about anything else. I just call what I see. And when I see money rotating into growth stocks, does that sound like the Great Depression 2.0 to you? It didn't to me. We were still seeing technology stocks leading on a relative basis. That would not happen in the Great Depression. So pretty early on, to me, it was obvious that this was a health concern, a big health concern, a big health issue, a big health risk, a health scare, whatever you want to call it. But financially, it was something that the market was already saying, we're going to get through this. And we're looking at the other side of the virus. And we're also looking at the stocks that could benefit because of the virus. And that's what led the growth stocks up for several months. Now, any trend, when you have an uptrend, it's really a definition, or the definition of an uptrend is just a series of higher highs and higher lows. If you're not putting in higher highs and higher lows, then you have either consolidation, or if you're doing it to the downside, you have a downtrend. So like right in here, see how we're going above the moving average, back below, no highs, no new lows. That is a period of consolidation. Over here, a period of consolidation. But when you start trending, and especially you can see that in 2020, when you start trending, you have higher highs and higher lows. So that's what's numbered here. Higher high, higher low, higher high, higher low, higher high, slightly higher low, higher high, higher low, higher high. Well, guess where we are now? Slightly below that 0.8. Now, that doesn't mean that we're going to be in this long, drawn-out downtrend. We could. I don't think we're going to. I think what we'll probably do, maybe we move all the way back down to this 0.6 and then we consolidate for a while. But I do believe with the economy, if the economy strengthens, which I believe it's going to, and now we're getting a lot more signals that that's going to happen. When you get transports breaking out, the Dow breaking out, there's your Dow theory. Dow Jones Industrial Average breaks out to an all-time high. The Dow Jones Transportation Average already had broken out to an all-time high. That's the confirmation of the Dow theory. So I think we're going higher. If you have high growth and you have low interest rates, normally your growth stocks are going to outperform. I think what we're seeing right now is simply the relief rally. Some of these stocks that were beaten up for so long are finally, with the vaccine news, getting a pop. I don't know how long it lasts. My guess is maybe it's going to last for a few weeks, that trade. I don't think that this is the trade for 2021. I think that we're going to see money rotating back into many of these growth stocks. I think if I had to say right now, 2021, I believe the NASDAQ outperforms the S&P 500. I don't know if it outperforms small caps. Small caps were beaten up for a long time, even before the virus hit. So I actually think small caps, this could be the start of something pretty good for small caps. We could be in for a couple years of nice action there. Just, an early call on my part. I'm obviously going to be monitoring that. But in our portfolios, we did put in a few more smaller cap, small to mid-size companies, and moved away a little bit more from some of the large cap stocks because of the rotation that we're seeing and the fact I think it could last for a while. Anyhow, this is I wanted to just point out the rotation that's taking place. I wrote, I don't know, maybe a couple weeks ago that this looked like it was rolling over to me. We've continued to see that. And again, I wouldn't be surprised to see it happen for a while, but I don't think this is long-term, not with interest rates. One of the Fed officials came out yesterday, I think it was, maybe it was Monday, and said they don't see any significant move or any hikes in Treasury yields or in Fed funds rate, I should say, until late 2023 or early 2024. That's going to keep rates low for an extended period of time, maybe up to 3 years. With growth picking up, money's going to rotate out of bonds. I mean, I think we're going to continue to have a melt up. I think we're going to have a great next few years in the market, stock market. All right, let's take a look at transports utilities. So this is a ratio I like to watch because when the market's defensive, it moves into utilities. When it likes the economy and what it sees going forward, it moves into transports. Well, I'm going to, let me make this chart 5 years instead of 1. During 2018 and 2019, when we had all of that, we had the trade war, then we had the pandemic in 2020 earlier, you can see this ratio was going down. Transports were underperforming utilities. The market was defensive, and we consolidated. Since March, this thing has been going straight up. So this is a signal to me that we've got really good action, I think, in the market as we go forward. And I think that's going to continue. But look at this breaking out above the September high. Even in the short term, when we consolidated September and October, we saw money rotate out of transports, profit taking more than anything. After the pullback, though, look at this push back to the upside, breaking out again. To me, this is very bullish. All right, I'm going to show you a scan. This is a scan that I run a lot, and it's a scan where I tend to buy a lot of stocks off of this scan. Earnings Beats members should know it pretty well. We have it listed on our website. We have some scanning strategies that we use against our chart lists. So we do all the research. We come up with these chart lists, and then we have our own set scans that we like to run against that chart list. And one of my favorites is looking for reversals. Now, this scan right here is essentially the scan that is used to look for reversals. It's a pretty basic scan. All it's saying is that the daily high today is greater than yesterday's daily high, but yesterday's high was below 2 days ago. 2 days ago's high was below 3 days ago. 3 days ago high was below 4 days ago, and so forth, going back 6 days. So essentially what we're seeing, what you would visualize in your head, is that over the past 5 days, the previous 5 days, the highs were getting lower and lower. And then all of a sudden, the day that I run the scan, we're seeing a higher high. Doesn't guarantee us anything, but what it could be suggesting is that downtrend has ended and we're starting to turn back to the upside. Now, the rest of this that you see are our chart lists. So I like to run it. We have a number of chart lists, but I like to run this against our strong earnings, strong future earnings, strong AD, and raised guidance. And the beauty of this is that these are fundamentally and technically strong stocks. We've already vetted them. We've already gone through and organized them into these chart lists. And so when these charts come up, chances are they're going to be pretty strong, either from a technical perspective or a fundamental perspective, or both. In order to get into the strong earnings chart list, you have to have both strong fundamentals and strong technicals. These others, I mean, raised guidance is obviously more fundamentally driven. Strong future earnings, strong AD, these are more technically driven. But the point is, we've got 4 separate chart lists, and we're running this scan against all 4. And you do that by running these OR scans. So you're taking this, and you need the double bracket here around the rest, because it's and any of these lists. So it's or. It could be in this chart list, the second one, third one, or fourth one, any of them. If it's in any of these chart lists and it meets this criteria, it picks it up. Now, I ran this 5 days ago, and I did it so that you can kind of see what happens. And I have actually had 2 recent questions from members asking about trading these and how I would evaluate trading these stocks. So I thought, okay, let's take a look at this and see what stocks come up. So we'll go through this kind of hopefully a little quickly. First one that came up was actually in gold mining. So remember, gold mining stocks had done well for a while. So I'm not sure which chart list this came from, but you can see the scooter is now down to 17. So this is a stock that's really kind of lost its luster. And I'm not a big fan of gold anyway. I probably wouldn't even have pulled the stock up because I'm not looking to buy gold stocks. I'm just not a fan. But here was the downtrend. This is again from 5 days ago. Here was the day where it broke this downtrend. Now, I would have looked at this and would not have been a fan. I mean, the stock relative to the S&P 500 is at a 4 or 5 month low. I don't view this just as consolidation. I don't like these stocks going forward. So I personally would have passed on that one. Salesforce.com. I like this stock. We got a double bottom here in play. The breakout or the move back to the upside would have come here. So right around the 16th, we see this break back to the upside. I like Salesforce. I mean, I think it's doing okay relative to software. Actually, it's near a 52-week high relative to software. Software overall has been pulling back a little bit, but I still a group I like. So I could have been okay with Salesforce. I don't own this one, but I would have been okay as long as it, say, trades above that 20-day moving average, or you could go down to these recent lows around 245-ish, and maybe if you want to give it a little bit more room, look down there. Night Laser, I just call it Laser, LASR. This is actually one of our portfolio stocks. So we moved up, downtrended for those 5 days, went back to the top of gap support, and then started to turn around. This one I think is definitely a tradable type of a stock on this reversal because I'm at a key support level. The top of gap support, when I get a big move up like that on heavy volume, I tend to look at the top of gap support as my support. So we tested it, reversed back up, looks pretty good. Now, from a short-term trading perspective, by the way, when you get back up near a recent high, I would consider taking the money. Now, even if you didn't get into this one until, say, 28.5 or whatever, when it gets up close to 32, I mean, you're up 10% or more. And I'm talking about 3 or 4 trading days. So I'm not trying to be a hero. As a short-term trader, I'm going to just take the money and run. Now, I happen to like the stock. I think it goes higher, but it comes down to what your goal is or, what your strategy is. Paylocity, PCTY, another one here that was moving up, came back down pretty close to this support area around 180 and then started to show that reversal. Went back up above the 20s, continues to trade above the 20, relative strength pretty good. It's a strong stock in software. This is the type of stock I would be okay with, although I don't own it. Pegasystems, PEGA, another one that was trending lower, but broke that, started to turn back up again. This one, I don't know, is kind of below the moving averages. I don't know. I probably would have passed on this one, but it's not a bad performer, and again, in that software space. I also went back and look at these. This is the 6 trading days back. So let me run a scan here and take a look at these stocks. So now these were 2, and I actually did own CRDF for a period of time. I traded and got out of it. Wish I had held it, but that's always the case. I made money, so I try not to look back. But CRDF, first of all, this is one of the strongest stocks in the market. Definitely one of the strongest biotechs. It is aggressive. Anytime you see a stock and it's in the biotech sector, think to yourself, higher risk, because most of them are. So I don't know what that means. Some of you might say, well, I don't want to trade a higher risk stock, and that's fine. Others might say, well, instead of buying, maybe if you're going to buy normally 10,000 shares, which would have been, or $10,000, not shares, $10,000 worth of stock, maybe instead of 600 shares, maybe you only do 300 because it's risky. Or if you're aggressive, you just do what you normally would do. But this stock had pulled back to its 20-day moving average, AD line strong. It's a leader. And I just really like this 20-day test. So I got in looking to hold on to that rising 20-day. And when it got back up, I don't remember where it was. It might have been around 1850 or something, right near these prior highs. I got out. And the stocks continued to move up, breaking out again. Let's see. The other one, Mattel, I think that one also was good, although I didn't own this one. Here was your pullback, and look at the bounce. There's basically the top of your gap support, 20-day moving average. Stocks bounce back very nicely. So these scans that we run, especially this one, I run this one almost every day. I run it every day, not almost every day. I usually will run it in the morning, and then I'll run it again in the evening or afternoon, maybe around 3 o'clock, and just see which stocks appear like they might be reversing. A lot of my trades come off of this scan. I love to buy pullbacks. I like strong stocks, which our chart lists pretty much guarantee us. And then I want pullbacks. I don't like to chase. And so I think this is a great scan. All right. Let's see. Next up. All right. Let's look at. Oh, I also wanted to mention short squeeze chart list, because that was not part of that scan. Here's our short squeeze chart list. And I pulled this up based on return over the last week. As money's been going into value, you can imagine value had been beaten down. So all the money was going into growth. So a lot of value stocks, a lot of stocks in that category were being shorted. And I mean, not all of these are value stocks, but many of them are. And so when the money starts rotating back, you can only imagine some of these heavily shorted stocks that are breaking out, the pressure that that's putting on anyone holding shorts. If you almost have to cover. So we're getting short squeezes. Look at some of these returns over the last week. Blink, that was on our short squeeze chart list. So when you get a breakout on a stock, look at this top right in here. Now, when it broke and the volume started picking up, some might say, well, it's all fundamentally based. I think that's hogwash. I think what's happening here is that shorts are boxed. They are boxed in. The stock's going up every day. They are literally losing their shorts here as the stock keeps going higher. And that's the beauty of the short squeeze chart list. I'm not interested in the short squeeze stocks when they're doing this, when they're trending lower. What I want to see is a breakout, and I want to see the volume start to pick up. These are the stocks that can make massive moves in short periods of time. This is a chart list. We get our members. We update it once a month so that our members always have the most heavily shorted stocks. 70, 80% of them in there I wouldn't even look at. They're in downtrends. They're being shorted for a reason. Avoid them. But there are plenty, like I said, that when they start breaking out, they can be powerful. Look at Workhorse when it came back up above the 20-day moving average. Now, this one's getting close to a key area of resistance up around 32, just below 32. If we get a breakout, watch the volume. I know it's already made a pretty big move, but this is a stock that was under heavy accumulation back earlier in the summer, has been going sideways for a while, could be very strong if we get a breakout there. The other thing is you can sort it by name, and we've got the most heavy, we've got it in order of short percentage of float. And so here's a one week. You can see some of the higher stocks, heavily shorted stocks, are performing pretty well. But you can go right down the list and find the ones that are, doing the strongest. You might say, hey, well, this one's got 46% of its float short, and it's gone up 14% in the last week. Let's see what's going on in the chart. Big breakout. It's pulled back right now, just kind of consolidating. But we get a close above 12, we might see another round of short covering. I would also suggest that you have somewhat of an aggressive mindset if you're going to trade these stocks. They can be extremely volatile. And so if you're someone who can't sleep at night, if you wake up to your stock being down 10 or 15%, you probably don't want to be touching these stocks because that can happen and does frequently. But you might wake up to your stock also being up 20%, especially when it's in a breakout like Blink or some of these others. AMC, which all of a sudden has, started to catch fire. Look at AMC. Big move up, came down to the 20, but now it just broke out again. And it is 9:30, so it's just opening. Is there a lot of risk to the downside? Absolutely. But when you get a breakout and you got a lot of folks on the short sides, it doesn't come down to fundamentals. A lot of times it just comes down to how much pain can I take? Um, Sometimes what I'll do is when you get these stocks in uptrends, if they have one day where they're pulling back, sometimes I try to get in just above the prior day's low, hoping that I catch the reversal. And if I don't, I get back out quickly. And I can get whipsawed. Like I said, this is aggressive, a very aggressive area of the market to trade. But I know that we've got a lot of aggressive traders that are members that want these kinds of stocks. You want the idea of maybe making 20, 30, 40% in a day or a week. You can't find something like that and then only be willing to risk 1%, to the downside. It's hard to do without being completely whipsawed. All right, let's move on to earnings, and we're going to wrap this thing up in just a minute. I just want to point out one earnings report. Deere, gapping up at the open today, not a surprise. This is one of our, actually it didn't gap up as much as it, in pre-market, it was up like $7. So it is up a couple of bucks. The report, though, is very strong, $2.39 in earnings. Market was only expecting $1.44. So very, very strong earnings report out of Deere. I suspect the stock is going to go higher. We do have a double top in play, and the stock's been bid up. Maybe we get a pullback to the 20-day first, but I do think eventually we're going higher with Deere. All right, 3 you must see. I'm going to start with the 3 best performing stocks in the Dow yesterday, and these are stocks that have not been very good performers until just recently. So we've got Chevron, CVX. Of course, energy's been on fire. This doesn't include today's action, so we'll look at that in just a second. But I would be looking for 100, that June high. I would not expect on the first move up that we're going to go through without a pullback. So I would be considering selling. If I was fortunate enough to be in this stock in November, I'd be thinking about taking my money off the table. And let's see if we go through June high. Maybe we do, but I'd want to see it first. So let's get an update and see what we're doing today. Down 1%, not bad. All right, next up. I'm going to be able to see. So the next one is JP Morgan. Again, we got to kind of reference where we were in June. We've cleared it. We cleared it with the first vaccine news. The other thing I'll say about JP Morgan is you do have one of the leaders in banks. So even though the stock maybe is in a group that's not great, and you can see that down here, we're starting to see the banks improve. But it's been, downtrending for a while. I wouldn't be surprised. I mean, we saw back in June this group move up and appear to be breaking out, and then we went right back down again. I wouldn't be surprised to see another move down, but I will say this. I like JP Morgan because it is one of the leaders in the banks. If I was going to get into a bank stock, this is one that I would consider. Just because I think it's going to be a little less volatile to the downside, and it is a leader. The last stock, and then we'll wrap up here, Goldman Sachs. Goldman Sachs definitely has finally made this breakout above the double top from June and July. I like that. A pullback to test, say, the low to mid 220s and the rising 20-day moving average would be best entry, just so you can manage your risk to the downside a little bit better. It's still not one of the best stocks within investment services. I think Morgan Stanley might have been doing a better job on a relative. Yeah, Morgan Stanley's much better. So if I was looking for a stock in this space, for me, I would prefer Morgan Stanley because of its relative strength. But again, same principles hold. I'd really like to get it on a 20-day test. All right, that is it for me. I do want to thank everybody for tuning in. Again, I want to wish everybody happy Thanksgiving. Be safe this weekend. One thing I will point out, if you are a Stock Charts member, even if you're not, I believe that they have a Cyber Monday sale coming up. And you can subscribe to Stock Charts, I believe, and I'm doing this off of memory, but I think you can subscribe for up to 2 years and get 4 months free. So you subscribe for 24 months, you get 4 months free. They'll give you 28 months. If you like what we do at Earnings Beats, or if you just want to try what we do at Earnings Beats and what um, Stock Charts does, you want to try out memberships to both, I would strongly encourage it. And like I said, I think Monday it might just be a one-day sale that they have, but take advantage of it. It's the best deal that they offer all year. I can tell you, we get nothing from you subscribing to Stock Charts. We don't have any financial connection with Stock Charts. So I'm not saying this because I want you to sign up and we're going to get some kind of a percentage. That doesn't happen. I am saying it though because I think our service combined with Stock Charts is powerful, and this is a way to lock in and save some money at Stock Charts for a period of time. So take a look and check that out. But I'm pretty sure it's Monday, and I believe when you go out 12 months, you get 2 months free, and if you go out 24 months, you get 4 months free, I believe. But anyway, check that out. All right, everybody have a great weekend. We are going to have a modified schedule at Earnings Beats this weekend. Friday, we're basically going to be closed. So if you do send emails in, you might not hear back throughout the weekend. I'm not sure what everyone's going to do schedule-wise, but I do want everybody to kind of, take a few days off and hang with family and so forth. I will probably write at least a brief daily market report on Friday because I will be following the market. Not going to guarantee it, but probably I'll have something come out, even if it's just a few lines about the market. All right, that is it for today. The next Trading Places Live will be right here at Earnings Beats on Monday. So there will be no Thursday Trading Places Live this week because of Thanksgiving. So next one will be next Monday at 9 a.m. right here. Have a great weekend, everybody. Be safe, and hopefully see you next Monday. Take care. Happy trading.